Welcome to OpalesqueTV. I'm Greg DeSpolbear with Opalesque New York, and today I have the privilege of having Bob Treue from Barnegat Fund with me. Bob, thank you for joining me today. Barnegat Fund is a relative value fixed income strategy that focuses on mispricings between securities around the world. Bob, what is relative value fixed income, and what does your firm do on a day-to-day basis?
For the Barnegat Fund, we look at government bonds throughout the developed world. We look at interest rate swaps, inflation swaps, futures, repo, little bit of options, and we're looking for mispricing between those products. So it could be one bond against another, it could be a yield curve butterfly, it could be a swap against the bond, it could be any combination of fixed income where there's an anomaly in prices. The main theme for us comes from people making non-economic decisions. So that could be panic, as in when Lehman went bankrupt and long-term went bankrupt. There was a lot of panic in the market. People sold whatever they had, and those products became mispriced relative to other products. It could be government intervention, like the UK quantitative easing was a good opening for us in the sense that you had an enormous buyer and an enormous seller, the UK Treasury. They were not allowed to trade with each other, so they created quite a bit of mispricing between the products they were buying and selling. It could be a regulatory situation. Late in the 90s, when Robert Maxwell looted the Times of London's pension fund and then killed himself, UK government came out and said, okay, all pension funds have to buy long-dated gilts. At that time, it wasn't a big deal because UK Treasury issued long-dated gilts. The pension funds bought the long-dated gilts. It was all fine. But then when Gordon Brown and Tony Blair balanced the budget, they no longer issued long-dated gilts. But the law was still on the books, so people were required to buy 30-year gilts. The pension funds were required to buy 30-year gilts. There was no longer an issuance, so those yields went crazy. So it's those non-economic decisions, that's what we focus on around the world.
What's the volume that comes out of your firm?
We trade quite infrequently. We focus on the large developed government bond and interest rate markets around the world. And we only have 15 to 20 trades on at any one point, and those trades are on for 1 to 2 years. So just from 15 to 20 trades that are on to 12 to 24 months, we really only trade once or twice a month. We spend our time just analyzing the different opportunities around the world, the different countries around the world, the government bond markets, interest rate swaps, inflation swaps, futures, repo, basis swaps. We're always looking at that, but the time we actually spend buying and selling is very little, just a couple times a month. And in general, I think that's one of the things that makes us unique is that we hold our trades for 1 to 2 years. We find an anomaly and we're happy to hold that. One of the things people ask us is what's the catalyst or what's going to cause that opportunity to come back into line? And we're not looking for a catalyst or something to cause it to snap back. We hold our trades for long periods of time, just looking to monetize the difference between these mispricings.
Bob, please tell us about your personal history and how you got into investing and managing money.
I got out of school and I worked on the exchange trading currencies for 1 year, which was a great opportunity learning how people make markets. From there, I had a lucky break. My college roommate was looking for a job, had an interview with a fixed income arbitrage firm, and asked me what fixed income arbitrage was. I described it to him. He said he had no interest in it. I said I would love to have that interview. And so I got the interview and worked at a firm in Princeton for 5 years that had fantastic success at fixed income arbitrage. And it was quite a lucky break. From there, Paloma, one of the larger funds, asked me to move to London and join their firm. That was the beginning of 1998. And I did that, so I moved to London. Then in the fall of 1998, Long-Term Capital went under. And I thought that was my chance to begin my own fund. There were fantastic opportunities in relative value, and I thought that was my chance. I thought I could go out, show investors these great arbitrage opportunities, and that they would trip over themselves trying to get into my fund. But that wasn't the case. So I had 2 years of very difficult times. I put all my own money into the fund to develop a track record and was making trades, and the returns were quite good, but I wasn't able to raise any money at all. After long-term had gone under, I went out and was doing my marketing, and we do similar trades to long-term capital in the sense of fixed income relative value, and it was a very taboo area because long-term had just gone bankrupt. I would show people these arbitrage opportunities, And they would say, oh, well, how many Nobel Prize winners do you have? And I said, well, I don't have any. And they would point out that, well, these guys doing similar stuff to you had 2 Nobel Prize winners, and they went bankrupt. Fixed income arbitrage is probably most famous for going bankrupt. It's a very difficult proposition to present to investors, that most of our competition went bankrupt when long-term capital went under. It's great for me as an investor. The employees of Barnegat own 20% of the fund, so that has been great for us in the sense that we have very little competition. It's very difficult to raise money for fixed income arbitrage, so that works nicely. But conversely, when we go out and try to raise money, it's a difficult point. Even now, with a 10-year track record, it's difficult to raise assets.
And what actually helped you to turn that corner as a young manager?
January 2001, 3 global investors invested in the fund and launched Barnegat with $25 million. Once the $25 million came into the fund, we got off the ground. We had interest rate swap lines in place, the derivative lines in place with various counterparties, and the opportunities were still there. They were still quite good after the long-term capital bankruptcy. So that presented a good situation for us, as in we had the investment in the fund, we had very little competition and good opportunities. And from there, it all went quite well. I continued to have good returns, but now able to raise other people's investments. We closed pretty much right away. We got to $500 million very quickly, and the fund was closed from 2001 to 2008. And so now we've just completed our 10th year, so we've had quite a good run.
Bob, how has your approach to the fixed income relative value strategy changed over the last decade?
Our fund strategy really hasn't changed that much. The differences over the 10 years have been the set of opportunities. So when long-term capital went bust in 1998, they wiped out the competition and left fantastic opportunities. That was a very good spot for us. Good spot continued pretty much until 2004, 2005, in the sense we had very little competition, very good opportunities. We put up very strong returns. 2005 to 2007, the economy was doing very well. The markets were getting quite efficient. Everything was moving along smoothly, which is kind of a bad spot for fixed income arbitrage in the sense that we don't have relative value opportunities. So we returned capital 3 separate times during that 2005 to 2007 period. Then 2008 occurs, Lehman Brothers goes bankrupt on September 15, and once again the cycle starts again. That competition gets wiped out, leaves excellent opportunities, and we're one of the few funds, one of the few fixed income relative value funds left standing, and we're in a very good spot again. So our strategy hasn't changed. As opportunities are good, we have more trades, we have more volatility, we take in assets. As the world is quite efficient, we have less trades, lower volatility, return assets to investors. So we've kind of come full circle. Long term was excellent opportunities. We took in assets. 2005 to 2007 was quite efficient. We returned assets. 2008 occurs. Excellent opportunities. Competition gets wiped out. We are open once again and open for investment, accepting assets, and with pretty good opportunities. 2008 was about the best opportunities ever. 2009 was quite good. We're still in quite a good spot. Not a great spot, but quite a good spot.
How would you identify yourself as being in a good spot right now?
Currently, we're in a good spot because the anomalies, there's not many people out there. We don't have much competition at the moment. There's not many people out there bringing the anomalies back into line. 2010, we were up 16%, and that was because 2008, things moved against us. 2009, things moved for us. Really what happened in 2010 is the anomalies just remained as they were, and we were able to monetize the difference in various yields, just to take in that 16% with very little volatility. So it was pretty much a perfect situation for us in 2010. So we're still in that good spot with not much competition and pretty good opportunities. For us, one of the problems with fixed income arbitrage is that when the world is efficient and doing very well, we don't have many opportunities, but everyone wants to invest in our fund because they've seen the returns from previously. But for us, when the world is having a difficult time, it presents great opportunities for us, but it's very difficult for investors to have spare capital at that point because the economy is struggling. So it's a difficult combination. We had net investments in 2008, and I think part of that was because us returning capital 3 times from 2005 to 2007, saying we don't have much to do. When we came back to them in 2008 and said we had fantastic opportunities, people listened to us, and we were able to raise money in 2008.
Bob, you closed your fund from 2001 to 2008, but you actually returned profits to investors from 2005 to 2007. Would you ever consider closing your fund again if you hit a certain level of assets?
We would consider that again. Currently, we're just below $500 million. which is a nice spot to be at. We had closed previously right around 500 million. Now we have pretty good opportunities. That's the reason that we're open currently. But speaking selfishly, the employees of Barnegat control 20% of the fund. So selfishly, we don't want to dilute ourselves that much. But additionally, I think one of the reasons that we survived in 2008, our competition did not, is that we were small enough that we could be quite nimble with our investments. We could move in and out of them, and we were able to free up collateral to survive 2008. It was a very difficult time for us, but we were small enough and nimble enough that we were able to survive. Now going forward, we have good opportunities, not great right now, but quite good opportunities. If the world became more efficient and we had profits from those opportunities and no new opportunities arose, yes, it's quite possible we could close again. I don't ever see us being a huge fund. I'm quite happy where we are currently.
Can you talk to us a little bit about your philosophy on excess collateral and liquidity? I know that's very important to you as a manager.
The big thing in fixed income arbitrage, we can go out and find trades that we know will make money if we're around at the maturity of the trade. So one example that had been written up in the press was there was an academic paper called The Largest Arbitrage Ever, and it was tips against Treasuries, both U.S. government bonds, both maturing at the same year, same time. In November 2008, this was the height of the mispricing between tips and Treasuries. Tips pay a real yield plus inflation, whatever inflation turns out to be. We don't know what it's going to be. Whatever it turns out to be, you get inflation plus that real yield. Treasuries just pay a straight yield, as everyone knows. In November 2008, we were able to go out and buy tips at 3.74% real yield, and we were able to lock in the inflation via an inflation swap at 1.36%. So in total, we were able to take in 5.1% on the Jan 2014 tips. At the same time, the Feb 2014 Treasuries were only yielding 2.56%. So we were able to set up a trade where they were both U.S. government bonds, similar maturities, exact same credit. One bond was yielding 5.1%. The Treasuries were only yielding 2.56%. So just very simply, we took in 5.1% a year, paid out 2.56% a year, and that's the kind of trades that we look at. Those come around from non-economic decisions. In this example, people panicked after Lehman went bust. Lehman also held a lot of tips that they had to sell as part of the bankruptcy process. So the tips, everybody started selling all the other complicated products of the world, and they felt the Treasuries were the safest product of the world. So everyone raced into Treasuries, driving those yields down and out of everything else, including tips, despite tips and Treasuries being very similar once you hedge out inflation. Nevertheless, we were able to buy tips at the 5.1% once we hedged out inflation and short the Treasuries at 2.56%. We know if we're here in 2014, we know that trade will make money. But, and then it's an important but, we have to be here in 2014. So as a comparison, long-term capital, all those fixed income trades, they were correct on those trades, but they weren't there at the end to collect the profits at the end. They weren't able to meet the margin calls along the way. So on your question of excess collateral, it's very important for us. We're able to find these trades. It's very important for us to be there at the end of the trade, at the maturity of the trade. So we carry about 40 to 50% of the fund in excess collateral. And so for the first 8 years of our fund, when everything was going fine and share price just kept going up, we didn't need that excess collateral. But then 2008 occurred, and all of a sudden that 40 to 50% of the fund that had just been sitting there collecting interest, collecting coupons, and doing nothing else was incredibly valuable. We were able to meet all the margin calls, survive a down year in 2008, and then to have our fantastic year in 2009. So it is incredibly important for fixed income arbitrage to have a lot of money sitting on the side just waiting for that time of chaos to be able to meet the margin calls and to continue on to the point where you can recognize the profits from your trades. In general, times of chaos are quite good for us. We lose money initially, and the way it's happened when long-term went bust and when Lehman went bust is that chaos comes into the world, we lose money initially, we have mark-to-market losses, our competition gets wiped out, we have the large stash of excess collateral, the 40 to 50% of the fund that's just sitting on the side, we're able to meet all the margin calls, and we're able to hold our opportunities until things come back to normalcy.
Bob, the employees of the Barnegat Fund actually own 20% of the firm. Can you talk about that and having your own workforce as an investor?
Yeah, so through the deferral, all of us have deferred for the first 8 years of the fund. The U.S. government now doesn't let us defer any longer into the offshore fund. But we've built up, obviously, quite a large holding. Given the profits over the years, we deferred management fees and incentive fees back in the fund. So the employees of Barnegat hold 20% of the fund itself. And I think that's a big, important factor, and one of the reasons why we survived 2008 and our competition did not, in the sense that when your own money's at risk, you're more careful, you hold more excess collateral on the side. Obviously, since your money is there, you don't want it to evaporate.
Bob, talk to us about the UK quantitative easing that you took advantage of.
UK quantitative easing was an excellent example of a non-economic decision. That's where we make our money, people making non-economic decisions. So in this case, the Bank of England began quantitative easing, and they were going to intervene in the gilt market to a huge size. They came in and bought about 40% of the outstanding gilts. Now, subsequently, there were more gilts issued, but the size at the time they began their intervention, they ended up buying 40% of the outstanding gilts. So they bought just between 5 years and 25 years. That was their target area. At the same time, the UK Treasury was selling any bond that the market would accept. So basically, from 0 to 50 years, the UK Treasury was issuing all sorts of gilts. With the Bank of England intervening in just a narrow channel there, we had an anomaly where even though the slope of the UK curve was positive in the sense that all longer dated yields were higher than shorter dated yields, and that's looking at the LIBOR curve. Whereas in government bonds, it was slightly different, that with the Bank of England intervening and buying 5-year bonds to a huge extent, the UK Treasury selling anything that the market would take, including bonds just short of 5-year, those two were not allowed to trade with each other. So the Bank of England actually drove the yields of the 5-year bond lower than the yields of the 4-year bond. So even though we're on a very positively sloped curve, with that intervention, there was a dip in the curve between 4-year and 5-year. We were able to buy 4.5-year bonds at 25 basis points higher than we were able to short the 5-year bond on a positively sloped curve. So one of the other appealing things about Barnegat is that we're uncorrelated to the other major investment markets. So Barnegat compared to U.S. bonds is a correlation of 0.15, global bonds 0.1, and there's some positive correlation there because we hold global bonds and U.S. bonds as collateral, so a little bit of positive correlation. But so do emerging market bonds, just a slight positive correlation. S&P 500, we have a slight negative correlation. Global stocks, 0.04, slight positive correlation. Same thing, emerging market stocks, and slight negative correlation to cash, U.S. cash. So overall, Barnegat has had very strong returns, but one of the things I'm particularly proud of is that it's uncorrelated to the rest of the markets.